This is where economists don't tell you the entire story. This chart shows the S&P 500 forward PE ratio from 1990 up to today. If we mark the major peaks and lows, we can see that low forward PE tends to show up around major stress points after the damage is already done, and high forward PE tends to show up late in long expansions. But how useful is that when the PE moves together with the markets? How is that a leading indicator? The PE does not tell you the market is about to crash anytime soon. It just provides an information that in the long term the valuations are inflated compared to forward earnings of those companies. In 1997 it was already targeting level of 20, which is super high, but it went up to about 4 more years of growth before the markets collapsed when the PE went up to 25. Valuations mean nothing in the short term. This chart is actually much better because it shows when valuations are adding to returns and when they stop doing that. Historically, the major equity tops don't happen when this measure is already deeply negative. They happen after it peaks and starts to fall. You see that into 2000. You see it into 2007. You see it into 2018. And you see it again around 2022, when tightening hit multiples. That's why the current reading near 0% is so important, even with the forward PE still high, around roughly 22. It tells you valuation expansion has already slowed to a standstill, and from here the market needs earnings to do most of the work. In our view, this is actually a very positive sign for the year of 2026, or at least few months ahead. As you see, when this curve starts to decline, it often comes before a larger correction, because it signals that investors are no longer willing to assign a higher multiple to earnings, even if earnings themselves are still holding up. Without a clear catalyst, high valuations will stay high. They don't mean revert on their own just because they look expensive to us, and it's important to keep the time horizon in mind. This market can stay in this overvalued regime for another 5 or 6 years and still be historically normal. The price-to-earnings ratio literally gets calculated of the S&P 500 index level divided by earnings per share. That means if the S&P 500 stands at 6,921 points and earnings per share stand at $309, then that translates into 22.4 price-to-earnings ratio. At Gleneus, we're always focused on providing you with outstanding analysis. However, none of the information provided should be considered financial advice or an investment recommendation. Our goal is serving you the best educational content. The US corporations are thriving. They have never had a better environment. We can tell that by this curve, which shows corporate profit margins as percentage of the economic output. As we see, this number is now around 13% over the past 5 years. From the 1970s to early 1980s, the low watermark is roughly 7 to 9%. In other words, capital's slice as measured by corporate profits is much larger now than in the 70s or 80s. Now the key question is this: what is the cause of this share growth? Are US companies profiting at expense of other subjects in economy? If we overlay the federal budget balance, we see that over the last 20 years the government has mostly run deficits. The main exception in the period from 1975 to today was the late 1990s, when the budget briefly moved into a surplus just before the year 2000. When you compare the two curves, you can see that corporate profits as a share of GDP are rising when the government is injecting more money into the economy through deficits. That is fiscal expansion. Monetary expansion is done by the central bank. Fiscal expansion is done by the government. On this chart, the relationship is clear. When government spending rises and the deficit widens, corporate profits as a share of GDP rise as well. These fiscal injections end up supporting corporate revenues and profits. But the other side of that is debt. Higher deficits mean a larger US debt pile over time. So yes, the government borrowed more, and corporate America ended up richer. How does it happen that these fiscal injections end up at corporations and not elsewhere? This excess government spending enters the economy either as government purchases like healthcare, defense, infrastructure, and transfers for households and subsidies. Money flows through firms, government buys goods and services from corporations, and households spend those transfers at corporations. That means that corporate revenues rise, costs lag revenues, and that happens. Wages, rents, and some inputs adjust slowly. Fixed costs stay fixed. The residual leads to profit of those corporations. Higher revenue minus slower moving costs leads to higher profits. At the macro level, it means the aggregate profits rise faster than GDP. That means profits to GDP ratio increases. None of the information provided should be considered financial advice or an investment recommendation. Our goal is serving you the best educational content. Thanks for watching. This is Gleneus.